All right, kids, class is in session. Today I have with me Sam Aker. Sam Aker analyzes penny stocks and writes a blog with original DD with an educational focus. Sam has been blogging for a little over a year and covers popular penny stocks such as AITX, ALPP, SIRC, and one of my personal favorites, CYBL. Sam has a degree in economics and works in corporate tax finance for a large multinational publicly traded company. You can find Sam at samakerfinance.com or on Twitter with the handle at samakerfinance. I'm going to put that all in the description below, so click and have a look. So without further hesitation, here we go. Sam Aker. Sam Aker, welcome to Buffalo Fireside Chats.
Yeah, great to be here. Thanks for having me, Rock.
All right, so we're just going to get right into this. So first, before we actually get into the actual 10K that we're going to look at, I did have a couple of questions for you. What motivated you to start a blog? What motivated you to start samakerfinance.com?
Yeah, I feel like it was really like I had been watching the OTC for a while and sort of investing on my own, not really talking about it with anyone really. And I'd see discussion about certain like financial topics, like what is this, what is that, like what's accounts receivable, like that kind of stuff. And people didn't really get it, and you didn't really find a lot of good OTC specific people really breaking things down like into the technical accounting bits, right? And I feel like a lot of people didn't really understand what they're investing in. And it sort of gave me like I don't know, I was really like thinking about it. And then I had sort of like an epiphany moment where I was on big mistake. I was on StockTwits, and there's this guy. I mean, this was like some unknown company, and they had just released a filing, and this guy was like just saying like the dumbest stuff about like just some really basic accounting things. And I was like, no, that's not how it works. Like that's not how it works. And I was like, why don't I just like write just write about this? And I mean, and it all went from there. Really, it all picked up really quick. I started writing about AITX. That was the first company, and their CEO Steve Reinhardt was a big supporter, big fan. He still is, even though I don't write about them quite as much as I used to. But that really took off from there. So that's sort of my backstory.
That's awesome. And guys, if you haven't checked that out already, in the description below, samakerfinance.com, give it a click. Now on this website, you have a guide to microcap stock analysis. What exactly is this, and who would find this useful?
Yeah, so this is something I'm still working on, though I will say the articles that I have written so far are probably the most important within that guide. It's really sort of like a more detailed version of what we're going to talk about today. But it's mostly for people who don't really have much of an accounting background, or maybe very basic. And you want to really more understand the nuts and bolts of the company that you're thinking about investing in, more than just like looking at the chart or technical analysis or just listening to interviews, things like that. So that I think that's probably more who it's designed for. I don't think an accounting professional is going to find much use out of it, but it's more for the someone who's doesn't know quite as much. So
Right on, man. And so today, what we're going to do is we're going to break through a 10K. And I think we decided on the INND 10K. Is that correct?
that's right. Yeah, I think this is a good company. People have asked me about it a bunch of times, and I normally don't. I try to stay away from healthcare, and biotech is normally what I tell people. This company is a little different because it's devices, which is it's not quite like developing a cancer drug or something. So it has a lot of followers, very controversial, and it has a lot of cool. I don't know. I wouldn't call it cool, but a lot of interesting things that I think a lot of people on the OTC do that are we good to show people and help them understand. So you should be able to apply this to a lot of other popular companies out there. So.
Oh, that's excellent. All right. Yeah. And I'll tell you, I read your articles, and sometimes you just put it right out there, the things that you don't want to hear. You're very objective when it comes to writing the articles. That's what I like. And so it gives people an opportunity to really reread what they read the first time, obviously, and just sort of digest it a little bit differently. You definitely break into it in a more specificity than anybody else out there. So why don't we just get into it? We can you could screen share. I enabled that for you, and I'm just going to be just sort of watching along. I might interrupt with a question, of course, because this is, and I am taking notes because, well, this is how you learn. I'm a paper and pen person. That's why I'm at. So
You're old school. You're a
I,
teacher.
I
That's
I am
how it
old,
works.
totally old school. So if I'm looking down, I'm not being rude. I'm just sort of taking notes. So
Oh no, you're all good.
Sam
Yeah,
Aker, take it away, brother.
yeah. So what we got here, 2022 annual report. Before we get really into it, I think it's helpful to understand sort of my approach to DD, and I think a lot of my usual readers probably know this already, but I'm more of a applying traditional investing, fundamental analysis to the OTC, which is probably like trying to fit a square peg in a round hole. But it is possible. But it's probably true that probably like 99% of the OTC is hot garbage. So this is a good way to just quickly knock out all the hot garbage and figure out what companies are exactly worth really diving into. So the general philosophy I think of in my head as I'm going through this, and we'll come back to this at the end, is it's all an odds game, right? With these things, there's a share price, a value of a company, and there's a bunch of stuff going on in the company, right? So the whole idea is you want to find companies that are sort of tilting your odds more towards success in your mind, right? It's all personal, but you don't just invest in any nonsense. You're trying to find the company that, yeah, maybe it's not going to work out, but it's has a 30% chance better working out than some other dog shit company that you were looking at before. And that's sort of like how you sort of narrow down your list. And over time, you're not going to win every single time, but you'll start winning more often than you were, I think, is if you were just throwing, darts at a board. So that's the general concept. So as we go through this, what we'll do is we'll find a lot of, I'll call them green flags and red flags.
Yeah.
And the whole concept is you just keep a running tally. And then when you're done, look at that list and then think, am I comfortable really spending the time, another 3, 4, 5 hours minimum, really digging into this company? And if not, you just throw it out and move on, and then maybe add it to a list you'll check again in 6, 12 months. And then if it is, then keep rolling. So this will be sort of like an initial screen, right? That's the general concept.
Yeah.
And what there's a few things I want to just sort of make clear before we start here. This is just my method. I mean, people make money lots of other ways. This isn't like foolproof. I've lost money on the OTC. Everybody has, right? This is the way I do it. So you don't have to if you don't want to.
That's
This
news
is
to
just
me. That the fact that people actually lost money on the OTC.
yeah.
Woo.
Yeah. Who knew, right? Also, this is just an initial screen, right? So you'll see things, you'll write down a green flag, and then when you do your deeper dives later, you could say, oh, this is actually not what I thought it was. It could be worse, could be better. And the same thing with a red flag, right? So I'm trying to simulate a first pass on a company here. So if I'd say something or, don't explain something totally perfect, and someone gets in an angry Twitter argument about how, like, oh, what do you mean? Like, you didn't read this blog post from 2018? Rah! Like, that's so remember that you'll
And
find out a lot more stuff later.
you and I both know there's always lingering information out there.
Yes,
It's bound to happen, especially with when you have these companies that are trading ownership constantly. So
absolutely. Yeah. So keep an open mind as you're going through these things. Sort of going along my next point here is it's okay to change your mind. Like, don't just like because you thought the company was cool when you did your initial screen, and then you start seeing all these awful things as you really start diving into it. Like, don't just cut your bait and stop. Like, you don't, or vice versa. Maybe it looked a little crappy, but you're like, I'll keep looking just in case, and then you find some good stuff. Like, trust what your most recent information's telling you, right? Um, and honestly, that's all my initial disclaimers, I guess I'll call them that. We can
yeah.
dive in if you're ready.
Oh yeah.
So the first place I like to start, and I'm going to scroll down here to get to it, and I think INND is a pretty good example for this, is I like to just get sort of my lay of the land of the company itself. Um, so really what I'm trying to do here, this is clearly something you need to go through more later, but you're just trying to get an idea of what the company does, what industry they're in, what's their role within the industry, How new are they? They've been around for a while? Are they brand new? Right. The whole point of this is that you should be thinking in your head, when this company, or if probably more like if it's the OTC, if this company is ever, you know, big in the industry or bigger as they're growing, right? What do I think their profitability could be? How fast could they be growing? Like if they're manufacturing nails, like it's probably pretty unrealistic that they're going to hit like 1,000% growth every year, something like that. But if it's in something else that's a bit of a faster growing industry, you could see that. You think about profit margins, right? That kind of stuff.
Yep.
So with I and D, just to keep this relevant, I mean, they're pretty clearly, they're in the over-the-counter hearing aid business, right? As you read through this, the kinds of things you want to be looking out for, what exactly is their functions? Like, what are they doing? As you'll see, they're pretty employee light. I think they only have maybe like 30, 40 employees, but they have their own suite of intangible properties. So they own their own suite of hearing aids. So they're not just like taking someone else's and reselling it, right? It's theirs, which should in your head signal more risk, but more reward in theory, right? They outsource all their manufacturing to China. Who doesn't? And they're competing against, lots of companies doing very similar things. When you think about I'll say the OTC in this case is over the counter healthcare, not over the counter stocks. That's going to be a little confusing as we go through this. I'll try.
OTC's flying everywhere. That's all right.
Yeah, everywhere. So as we think about over the counter healthcare, you have to think lower margins, more competition. That's the whole point, right? It's about lowering prices to the end customer. We'll call them customers. But at the same time, it's also about taking market share away from the future or the past people who were the big players, right? Because they had they were milking Medicare for all it's worth, right? And now we have all your grandmas and stuff going down to Walmart and can just pick up hearing aids off the shelf, and it's much cheaper, more accessible, right? But very competitive. So we can't expect, the usual pharma 30% margins, tons of money, right? More than they know what to do with. This is going to be probably a little bit more of a volume play, but definitely room for profit, right? So that's sort of our baseline here. So we have to remember, they have their own suite of products, manufacturing's outsourced, competitive market, but not impossible. Like we're not talking like 2% margins here. And there is room for growth because this is a new area where you couldn't actually do over the counter hearing aids until very recently, like in the last like 6 months or whatever that FDA.
Yeah, and there's just the fact that it's consumer driven too is important.
Exactly. Right. So you have to make sure that their products are, have good reviews. Like you can buy them anywhere, right? So you can look online and go on like Amazon or Walmart.com and see what people are saying, all that, right? We won't do that today, but that's what you need to do next. So that's, I think, probably our company background section. So just keep all of that in mind as we're going through financials, because the financials won't make any sense unless you sort of know what they're doing, right?
Yeah, and you know what? When you talk about the products and stuff, like I just did that with CGRA. I invested in them. It was one of my Nick Link plays. What did I do? I went on the website and I actually bought one of their shirts to make sure I was actually getting a product. You know what I mean?
You'd be surprised.
So I'm like, all right, so like that's what you do, like that, and that's just this common sense DD. Like if you're gonna like the whole thing with the hearing aids thing, can you find it on Amazon? Can you find it on all these resources, Walmart.com or like any of these things? So once you do see that, then that sort of it's like an ultra confirmation that it's real,
Absolutely. Yeah.
So,
and you never, as a general guideline, never assume with an OTC company like that whatever they're saying is happening, or that something they sell is real. Like it's just don't assume. We'll just leave it at that.
And just for the record, I didn't think CGRA was a scam. I was going to get a shirt anyways. So I could see where this is going. Somebody's going to say, Oh yeah, see, he was worried about CGI. That's why he bought the shirt. No, it was going to happen either way. But
Oh no, don't worry. Someone's gonna get angry out there. Don't worry.
regardless, I
Yeah,
could
no matter
say.
what we say, I just probably pissed off a third of IND investors. Something I've already said. Um, okay, so after I look at the company, and normally as I go through these, I can do it pretty quick. But if I see something that's just a complete no go, I'll just stop. So if I read something up above that I didn't like, I could sometimes just stop there. But if not, I like to run through financials next, right? I'll skip the balance sheet. I think it's actually better to go through your income statement first. So this is probably the most important, one of the most important sections, right? Um, income statement analysis. So an income statement, right? All it is it's for a 12-month period, generally 12 months. Basically, how did the company do, right? What was their financial performance? So I don't want to get too into the nuts and bolts of accounting, but remember that this is accrual accounting, not cash, right? So a lot of these are estimates of what they think their revenue was for a period based on accounting rules, right? This isn't like $15.2 million in cash walked through their door. It's, oh, they actually have a typo here. This needs to be.
Oh, you're known to find those.
Yeah, you can see they were using negatives here and then positives here, but yet it's still reducing. Anyway, sorry, I didn't actually notice that when I went through this the first time. See, there you go. Not a good sign. You can mark that as a red flag. So, typos in their financial statements. Anyways, so this is accrual accounting, right? So they're estimating that their revenue for the year was 15.28 million, right? What does that mean? So generally, we'll talk about US GAAP just because these are all mostly American companies. There's certain trigger points of when you can recognize revenue, right? Doesn't mean cash is walked through the door. It means you recognize revenue. So for a company like this, what it usually means is that they've received an order. For hearing aids, let's say Walmart wants 1,000 hearing aids, right? They receive an order. They say, okay, we'll make it. Their Chinese manufacturer makes it, ships it to the US. It hits a warehouse probably in wherever they are. I think it's in California, or it just goes right to Walmart's distribution center. And then the second it passes title to Walmart, they book it as revenue, right? Or when it ships to them, right? So they might actually not get paid for like another 30 or 60 days, which will be in their accounts receivable, right? Which is up above. So remember, this is an estimate of revenue, right? They haven't collected on it, right? It's they think they will, but they haven't necessarily, right? So moving on from there, we have our revenue. So that's top line. Cost of sales, very important. This is basically for this revenue that they accrued, how much did it cost directly, right? So for a company like IND, this is probably the cost of manufacturing the hearing aids, right? So it's basically what that Chinese manufacturer charged them.
Would that cost, like something like that for cost of sales? Would that include the shipping to these companies as well? Let's say it was shipped from China to a Walmart facility. Would cost of sales include shipping and any of those delivery costs as well?
Yes.
Okay.
Yes. So assuming that Walmart didn't pay for it themselves directly, it would usually you include all of your as direct of costs as you can find. So even for like a manufacturer, like if they were manufacturing themselves, they would include like their factory workers' wages and things in here, right? Because it's direct, it's right for the products. So what you get from there is what's called gross profit, which is sort of like I think you're actually talking about this the other day, but it's your bread and butter sort of the company, right? It's how much money are you making just from pushing product out the door? How much does it cost to make, and how much did you sell it for, and then how much profit did you make, right? So you should see a decently healthy gross profit that ideally would cover all your other back office expenses, we'll call it, or your other indirect expenses. So that's gross profit. We don't have a lot of ability to sort of compare to prior year because this company is so new, but ideally you want to see gross profit margins. So, the 9 million divided by 15.2 staying pretty steady or growing. You probably don't want to see them thinning. So that's gross profit. We can see here they've clearly made good money at a gross level, which means their manufacturing costs are probably quite low. They're doing it in China, so that kind of makes sense. So from there is where we get the rest of our operating expenses, right? So these are to run the business, right? So compensation and benefits, this is all indirect, remember, most likely. So this is people like probably their management, things like that, salespeople, right? All of that. Advertising, promotion, this is stuff they're probably paying to advertising firms, whatever. They might actually have to pay Walmart or something to help advertise these, share advertising costs, that kind of stuff. Professional fees, obviously like accounting, legal. Their rent on buildings, which are used for more than just direct costs. Now there's your investor relations. There we go. Put this nice file together. Depreciation, amortization. I think we all sort of know what that is. It's basically like as you buy equipment, you don't expense it all right away. It's expensed over time, even though the cash has already moved out the door.
And I learned that in my real estate course, and it's so important
Yes.
because as you do that, that goes right into how much taxes you're going to end up paying. So
exactly,
like spreading it out over time, and that it makes sense to do that.
Yes.
It alleviates the tax pain, I guess you
Yes.
could say.
Yeah, and it sort of makes sense logically because let's say like their depreciation amortization is probably like they probably have like equipment or something in the US or something like that. And it doesn't make sense to expense it all up front when you're going to use it for 5, 10, 15 years. And but just know this is a non-cash expense, right? They've already paid the cash. This is just them recognizing an expense. And that sort of goes along with a lot of this other stuff. They're recognizing an expense, but they might have not paid it right away. Like say their professional fees, 635K. Maybe they've only received an invoice for it for parts of it, but they haven't paid it all yet. Maybe they have 30, 60-day payment terms, right? So they recognize the expense, but cash hasn't left the business, right? So my favorite metric of a company like this is profit and loss from operations. I call it like operating income, operating margins, right? This basically shows you your full cost of running the business before we get into other income and expense from financing, interest, whatever. So the general concept is you earn profit from operations, which you then use to pay your financing costs or whatever other expense down here is generally financing costs, non-operating expenses of the business, right? Again, this company was very unprofitable before, and now it is, which is cool. I didn't break it down by quarter, so I didn't really see between 2022 which quarters were best, but over the whole year, they earned a profit, estimated profit, right? This isn't cash profit. They didn't have $909 come through the door exactly, right? So this is probably my favorite way to really look at the health of a company business-wise is this, and then we'll get to some of the cash flow metrics later. Moving on then, this is where I think it's the most complicated, but also probably is okay to, I wouldn't say ignore, but it sort of gives you a distorted picture of profit, right? So for an OTC company, a lot of them have a bunch of garbage down here that's causing a lot of income or loss over time, right? But starting at the most basic one here, interest expense, right? Everyone, I think, probably knows what interest expense is. If you have a mortgage, a loan, whatever, they charge you interest on the money you borrowed. As you borrow money, the only thing you expense on the income statement is interest. You don't expense the money you're paying back. That's taken account down below in cash flow. Because you've borrowed it and given it back, it has no income statement value to it, unless, which we'll talk about, some of it was forgiven, right? So what we've seen here, they have amortization of a debt discount. This is interest expense. It's just non-cash. I won't get into why. That's a dense topic, but just this is interest expense. This is obviously interest expense because it's called interest expense. And the last two things on here that are interesting is gain or loss on market value of derivative liability. This is basically them having convertible debt that had a conversion option on it. And over time, because it's debt, it's attached to debt, there's a value of those options, that conversion option, right? They might have warrants too, which would be in here. But as the stock price changes, it changes the value of that derivative liability, right? So a gain here means that a good thing happened
All
in the
right.
in the idea of the company. So versus when they gave out that conversion option versus where the price is now, it's a gain, right? The other thing that's big here, and I think we can mark this one down as a both a green flag and a red flag, and you guys can read about it a lot. Is they had a big extinguishment of debt. They got a whole bunch of debt forgiven, and we'll talk about that. But that's what this big gain
Wow.
is here: is they owed a bunch of money and someone forgave it, right? So that's why we're seeing a big profit of other income and a big net income gain, right? Net income is earnings before tax. Net income is after taxes, but you'll be hard pressed to find an OTC company paying income tax. Which is sort of funny even because this company technically on an income statement basis made money last year with almost no revenue because of these derivatives.
Okay.
So this is nonsense. Don't even think like, oh wow, like they made money. Ooh, like it's nonsense. This is what you want to follow, this operating income, and then everything else is sort of like secondary. Like
Yeah.
so. Any thoughts before I keep moving on or on income statement?
No, this sort of makes sense to me. I'm a charts guy. I know a lot of people are. So like this is the first thing I look for. I do look for that's one thing I look for is the profit from or loss from operations. I'm seeing a lot of positive things here too. I do look for revenues because in regardless like you do want to see a revenue increase year on year, because that should increase your profitability. Should you know
Yes.
but so the gross profit, I'm pretty good. I'm not in INND, but you're getting me pretty excited about this one because I could see a lot of positives here. So
Don't worry. I'm sure I'll say something later that's
yeah,
going to piss all the INND
all
investors
right.
off.
If you could break my heart after you bought me some roses, that's okay.
Give a bottle of wine. So I think as we sort of just review here quickly, growing is definitely a good thing. Like that's a nice green flag right there. If we want to mark that one down, we'll mark this as a 2. We'll discuss this debt extinguishment because you'd think debt extinguishment would be good, but there's no free lunch out there. Something happened here. We'll talk about it. Operating profit good, right? So all in all, I think income statement is showing some pretty good stuff on its own, right? From operations. Some of the stuff down here is a little bit funky, but more to come. So from there, I like to go balance sheet, and I think we can move through this one pretty quickly. So this is a snapshot of financial health of a company, not performance necessarily, right? So it's just on 2 days within a 12-month period. So it was what their balance sheet was on December 31st, 2021 and 2022. Doesn't show anything throughout the year unless you want to pull quarterly filings. This is just 2 points. So
Okay.
the general idea of a company's health, if you think about your own personal balance sheet, right? You own some things, right? Assets that are, the technical definition is they provide some economic benefit to you in the future, right? So like I'm sitting on a chair right now that's providing some economic benefit, right? But they also owe some money, right? So some of us have a mortgage, right? You might have a lease where you have to pay rent, right? That kind of stuff. So with any company, right, they have assets, liabilities, and then whatever the difference is between the two is what's called our equity in the company, right? Surprisingly, this company has positive equity. You don't see that very much on the OTC. Normally, this looks like a fucking disaster when you pull up a balance sheet. But the idea that the way I sort of think about shareholder equity is we have all these values of assets on the balance sheet, and let's just say that for argument's sake, these assets are valued correctly at their book value. So if you take all the assets, liquidate them, we have $36.2 million in the bank. We have to pay off all of our liabilities, 17.1. So whatever's left over is $19 million. So if the company was liquidated today, in theory, you would have $19 million that the shareholders could all fight over. I mean, this is obviously
Okay.
not like, none of these are at their correct values. This is just book value of things, but it's an estimate, right? It's how accounting methods want it to work. There's a lot of games people play about trying to figure out what the real carrying value of assets are and liabilities, and then finding undervalued companies that way, right? It's
And
like corporate.
is there an equation that you would divide that by the number of outstanding shares or?
Yes.
Okay.
Yeah. So it's the price per book. Um, the or book value per share is the formula people know. So it's like your book value of equity, 19 million, divided by total outstanding shares. Um, just to be clear, we'll talk about this later. The actual amount of shares outstanding for this company is not really how many shares that are out there because of these convertible preferreds. I know you guys all love and hate me for how much I talk about convertible
You
preferred shares.
do. You do. That's your jam.
Yeah, that's my thing. I think it's we'll get there. So anyway, when we look at let's talk about I and D now, right? So well, we have our current assets are broken down between current and non-current, right? So current assets are basically anything that's going to provide an economic value within the next 12 months is the idea. So it's things like very short-term things like cash, AR. For some reason, they have receivables from a related party, inventory. So things that are easily liquidated and are actually very close to their real value. So this is probably a pretty close estimation of what everything is worth on their current assets. Non-current assets are generally your intangible property and any like equipment, property, land, that kind of stuff, right? So you can see they have intangible assets and goodwill, probably from when they bought a subsidiary, which they did. We won't talk about that. That's a whole, I could talk for an hour about this. We have their PP&E, plant, property, and equipment, I'll call it. Net of depreciation. Remember we talked about depreciation earlier. So it's being removed from the carrying value. And then they have an investment in undivided interest in real estate, which is, this is a bizarre one, but
Yeah.
we'll talk about that. So that's their asset base, right? This is sort of what they own and what they think will give them benefit in the future.
So that, by the way, that undivided interest in real that would be a shared property, I would think, with some other entity.
Correct.
So all right.
That's
what I see.
This is
the
the
learning
reason I'm
sort of paid
laughing
off.
is this is a
Yeah.
funny
Yeah.
the way they account for this is a bit weird, and like their partner is actually a related party. So
Got it. Yeah.
it's a whole thing.
Okay.
So flipping over to their liabilities now, what do they owe, right? So current liabilities, same thing as current assets. It's an outflow within 12 months. So this is probably very close to what they actually owe, if not exactly what they owe. Most of what they owe is accounts payable and accrued expenses. What this means is that if we go down through, so 9.1 million, that's a lot of money, right? It's all the money they owe from their expenses here that they haven't paid yet, is the idea, right?
Okay.
So they might have bought a ton of inventory and they had maybe 90-day payment terms to their Chinese manufacturer and they haven't paid it, but they still recognize the expense because they sold the product, right?
Yes.
So this will have to be paid. Everything else current here is very small. Operating lease is really the only other one, which they have a lease of a building they own, which is actually this.
Yeah.
Again, it's a weird
one.
Long-term liabilities. This is where you see like debt mostly, or a long-term lease. Anything that is going to come due in more than 12 months, right? The principal of it, not interest, principal, right? So if you had current interest, it would be up here. I think you can actually see some of notes payable here. I don't know if there's an interest payable in here somewhere, but there may be. Anyway, so this is like mostly their debt, right? Long-term portion of debt. Debt. Other long-term liability. You can mark this one down as a red flag because we don't really see a lot of info on this one throughout the rest of the report. We don't really see about this line of credit, what it's all about, 1.5 million, right? So they have some debt here. Which we need to investigate more, but sneaking ahead here, there isn't much info on it, right? I'm gonna breeze right over shareholders' equity. This is a weird section, and this is too theoretical for what you need to know. As long as you know assets, liabilities, and we'll figure out the amount of shares outstanding, common shares, the real number. That's all you got to know, right? That's balance sheet in a nutshell. That's the idea, right?
Right on.
Any thoughts before I move on?
No, it's a lot. You know what? And that's the thing. Like every 10K is different. So, you're really pointing out the bullet points. I'm sorry, that basically the headers, current assets, total assets, current liabilities. Those are the important things. They're going to differ, obviously, and this is the truth for every 10K. Everything below those things is going to be different because every business is different. So, if I'm gathering correctly there, is there any specific equation? I know I keep saying the word equation because I think people like formulas just so that way they could look at a 10K and sort of apply it.
Yeah.
Basically like what you said in regard, and I know I probably I can't think of the right words sometimes, but I think you get what I'm saying. Is there an equation like on this balance sheet, especially when it comes to assets and liabilities? And I think you pretty much just explained it. Could you just recap on that again?
Yeah.
Just yeah.
So, right, equity is the first one we really want to know, and that's literally just total assets minus total liabilities, right? So you want to see if you have positive equity, that means the book value of your assets is greater than the book value of your liabilities. Technically, that means the company is solvent. It means like, if you liquidated everything at your book value and then paid off all your liabilities, what do I have left? You have extra money left. The other very important one, and I forgot to mention this, I'm glad you brought this question up. There's this thing that's called the current ratio, which is very, very, very important for OTC companies.
Current ratio,
which is just current assets divided by current liabilities. And I don't know why they make this one a division problem, but it is in the finance world. You want the number to be greater than 1. So if we have 7.8 million of current assets divided by 9.7 million of current liabilities, that means it's less than 1. It's like 0.8, 0.9, right? It means that in the next 12 months, they're going to have a cash shortfall in theory. Their current assets are not good enough to meet their current liabilities, which means either the business has to generate enough cash in the next 12 months to pay off the difference, or they need to raise money, right?
yeah.
And as we'll see below, the company may not be cash flow positive right now, even though they're profitable, which should signal in your head there's going to be some sort of financing raise coming up, right?
Okay.
Debt, equity, whatever, right? So those are probably the two most important ones. We don't need to talk about like return on assets or anything like that. That's a topic for another day. So,
and I know one IND shareholder right now is probably like, "What do you mean it's not greater than 1?" I go,
what?
"Hey, 8 is still close to 1. Let's just do that."
This is much better than what you normally see. Normally, you'll see like 1 million in current assets and like 20 million in current liabilities. So this is
That's
not
funny.
that bad. So let's move on here. I
Yeah,
think
let's go on.
my next area here is cash flow statements. This is a tricky one for people, and I think a lot of people misunderstand this statement. I think I use a lot of different metrics on here because some of the formulas you see that are built into the actual statement are a little flawed, in my opinion, but they're like that for a reason. So remember I said above in the income statement, this is all estimates, right? This isn't cash movement, right? Down here is where we see a reconciliation to cash, right? So we have our net income of 5.5 million, which comes right from the income statement. They should be the same. They're not always the same on the OTC, given the quality of reporting. So basically what this is going to do is it's going to reverse out anything that was a non-cash item. And then it's going to go through the changes in operating assets and liabilities, which are basically just your current assets and current liabilities, right? Working capital is really, it's like inventory, accounts payable, accounts receivable, that kind of stuff. It's all here. So running down the sheet here, we already knew, like I mentioned, all of those other income expense items from up above, these ones, the 2.8 million, 2 million, right? Not cash. There's no cash movement because of these on an operating sense. So this is reversed out. So a negative number means that you didn't actually earn this cash, right? The net income makes it look like you earned 5.5 million in cash, but you didn't. And then so a negative number takes it out. 2 million puts it back in, 460 puts it back in, 4.8 takes it out, and so on. Stock comp, non-cash, right? That's another 415K of an expense that wasn't a cash item, right?
Yes.
And so you sort of have to play around with this and sort of understand the math, right? The important ones I wanted to show, because we already sort of talked about these and non-cash items from the income statement, operating assets and liabilities. So if you're using the same logic, a negative accounts receivable amount here means that it's removing cash from net income, which means that you had 2.8 million in revenue recognized, that you didn't collect on yet. So you really only collected on maybe like 13 or 12 and a half or something like that, right? That's roughly how you should think about it. An employee advance, it means you paid someone ahead of time, right? Inventory, big one, 3.4 million increase in inventory. So it's decreasing cash. That means that you purchased more inventory than what you sold. So of this inventory amount in 6.2 million, you also bought another 3.4 million, call it. That's maybe oversimplifying a little, but that's basically what's happening. The other funny one you see on the OTC, your accounts payable going up. People on the OTC hate paying their bills. So this is cash going up because you had a payable and an expense, accrued expense that you didn't pay, right? So you didn't actually have a cash go movement out, right? And it's what's sort of funny is, they also had a related party receivable who didn't actually pay them, right? So that's always nice. And at the end of the day, you get down to what's called cash used in operating activities, right? So they actually were not even close to cash flow positive, 5.3 million in the hole in terms of cash, even though they had operating profit and net income, right? So this is very important. It's a growing company, which means they're sort of in this collection cycle where they haven't actually collected on everything yet, right? And it's not guaranteed that they actually will, right? By Circ investors out there, I know if you're listening, you know what I'm talking about. These are the kinds of things you have to really watch for is, net income and operating income looks great, but are they collecting? And do you think they'll actually ever collect on all this stuff? That's the idea. And if you'll see above, I didn't talk about this yet because I wanted to show you the cash flow statement. Look how much cash they have in the bank, 76K. This company's hemorrhaging money. Like that, there's no if and or but about it. They're raising money and they don't have any. They're not cash flow positive yet. They might be if they can collect on everything, if they can keep it up. But if not, they have to keep raising cash to meet their expenses. So there you go. That's sort of, this is, I think, probably the more important part. This is like all your operating cash, the important part. So all clear. I think that was the whole section actually, because my next one is going to talk about everything else.
Right on.
So from here, this is where I think things get tricky. So you have a really good idea of how they're operating, right? So you've seen what their accrued revenue and expenses, right? You've seen cash movement operating wise, right? Now we get to see nuts and bolts, how they're raising money and what they're doing with it, right? And I think this is where I think people get a little lost. And this is one of the poorer areas of OTC reporting, is just the level of detail on a lot of this stuff. But what we'll do is, the first place to really look is, we already have been pretty clear that they're not generating cash and they're really cash strapped, and they have had to raise money clearly, right? So how have they been doing it? So if we just look straight from the financing section, right, we can see how they've raised money. How they have positive bank fees, I have absolutely no idea, but it's they must have gotten a refund or something. But they've raised from issuances of common stock straight up 350K. They've been issuing convertible notes, conventional loans, non-convertible notes, and they have a line of credit. All right. So normally with a company like this, you should be able to sort of see this debt being raised and then pop up to your balance sheet and see similar amounts of debt on here. The reason we're not is because of this debt forgiveness, which we'll talk about, which was 4.8 million value of principal that was forgiven and accrued interest, but which is pretty close to a lot of this debt amount that's been raised over the last 2 years, right? So a lot of this stuff has been forgiven, it looks like. So they've raised all this money, right? We're seeing the words convertible in here. Usually no bueno on the OTC, right? And issuances of common stock could be good, could be bad, right? The best place to look for all of this is, or I guess maybe stepping back, what we want to do is, now we've seen all this stuff being issued, we know how they're raising money. You need to see sort of what are the terms they're getting, right? So for common stock equity issuances, we'll call it, you should be issuing very close to market value at the time, right? Um, it's basically the only way it's not toxic, right? Debt should be at a market interest rate, and conversion features on convertible notes should be very close to market price, which is like me asking for a stranger to give me $1 million. It never is. Unless you're borrowing from Brett Rosen, but they are definitely not in this case. So maybe starting with common stock, right? We can check quickly what kind of price they're getting. If you just pop up to this nice issuance statement up above, which OTC Markets makes you do, you can see all the common stock they've been issuing, right? And it should be these ones that don't say conversion. That's for other things, right? But we see that like these people have bought stock, right? These fine fellows are investing in the company, right? Small amounts, right? 200K at a time, right? Why it said that they've only raised 350K from issuances when you see all these acquisitions here. Something that you need to investigate more. I'm probably missing something, right? But this should be on your list as probably a red flag for now. So you can see basically what price they're issuing all their acquisition amounts at, right?
Yes.
What's their dilution look like? From there, then you can look at what their debt terms were like, which, oops, this is where I think this is a pretty big red flag for me. Is their debt, the way they describe their debt isn't very good. So you see they raised all this debt. They have all these convertible notes, loans, non-convertible notes, line of credit. Normally, companies are supposed to describe every single debt liability they have, right? And you should see it on the balance sheet too. So there should be something that's a little more detailed than other long-term liability with no explanation. So if we go down, what I'm getting at is when we get into the notes to the financial statement, you'll see they have all these convertible notes, and every single one of them ends with the loan was fully forgiven, the loan was fully forgiven, the loan was fully forgiven, right? And it just keeps going and going and going. And all they talk about are the loans that were fully forgiven, which are most of them, I will say, but there's still that other long-term liability they haven't talked about. So that's a red flag right there. Definitely don't know what their debt is. I'll call this one a red flag and a green flag at the same time. Why the fuck is someone forgiving all of this debt for no reason, right? And all my IND shareholders are probably pounding the desk right now because they know something about why. And just, if you read their 8Ks, right, which I did before this, but I'm trying to simulate going through it the first time, you should be very confused seeing this. You know, this should be like alarm bells in your head. Nothing's for free, right?
Yeah.
Why would a company do this? Or why would an investor do this? Turns out, if you want to think about the way I think about it, no one really knows why. For sure they did it. But the company that did it was this company called GS Capital Partners. And you can see them in here about 1 million times, right? These people doing little conversions. This is almost certainly interest expense that was being converted to shares, right? Big discount. You can see my theory, again, needs to be, this is what I'd hammer out in my next step, or my next deep dive. But this company has probably made so much fucking money on this company that, and they own so many shares that they haven't sold yet, that it's almost better for them to just forgive the debt.
Okay.
To keep the company up, because they have, I mean, if you just sit here and add up every single GS Capital Partners,
A lot of shares.
even just from right here, there's like 600 million shares, right? At least. And I'm only on one page.
Yeah, that's crazy.
So they probably made so much fucking money off this company that they want to keep a good relationship and keep being a financial partner to them.
Okay.
But that's my theory. We'll see. But in general, your thought with raising financing is just, is it as close to market rate as possible, right? That's your goal. Dilution isn't always bad if it's at market rate and it's used for something useful. Dilution is not bad. Most of the time, dilution does not meet those criteria. But this is a very, very, very important section, just because it really tells you a lot about the company and how how financially strong they are in terms of how they raise money. It's very important. So I could talk about this for 3 hours, so I'll stop there. But that should give you a good
It does.
idea of what you should be looking for in terms of how a company raises cash.
And there's a lot of companies out there where they add shares, and what they're getting isn't anything
Nothing.
substantial. Like you have,
Yeah.
they could be acquiring companies that aren't even producing profits, no revenues, no nothing. They could just be purchasing an idea at that point. Where there are some good companies out there that they have to increase, have to issue shares for positive things, such as
Yes.
revenue producing companies or companies that are profitable. So I understand exactly what you're saying there, and so
Yes.
I think that's important. So you're differentiating between good dilution and bad dilution.
Absolutely. That's the whole point. Think of it like an investment, right?
Yep.
There's no free money, right? It's going to cost you something. So as long as you reinvested in something as a higher rate of return than the cost to you, it was a good thing for investors. Most of the time, companies don't do that. They pay themselves. They buy stupid shit. They're just throwing money away, right? But I'm not saying that's what INND is doing. I'm just saying they've had to raise a lot of money, had to do a lot of dilution, and somehow they magically got a bunch of debt forgiven. So something to consider in the deep dive. Okay, so that's business financing. We're in the home stretch here, guys, and I think this is actually the juiciest part of the interview.
Wait, I'll tell you right now, like this is meaty. You know what I mean? I'm gonna break this, guys. I am gonna break this up into segments.
Yep.
And Sam, I'm gonna ask you just to at some point to let me know where you want me to break it down, where you think it will be most valuable to the viewer. So hey, listen, if you want to knock your kids out, just play this whole interview for them, and your kids will be asleep within 5 minutes, I promise. But for us that are trading and investing, this is really important information. And Sam, thanks again for coming on. I appreciate that. But I'll let you continue on. We are in the home stretch, as Sam just said. So
stretch here.
Awesome.
So this last section, and this is probably the spiciest one. This is probably where I'm either going to rile up the INND haters or lovers, depending on how you take this next part. But this is what I call the ownership section, right? Very important that you understand this. And I break the ownership section into two parts. What are the classes of shares out there? And then what is the real number of common stock? And then who owns those shares, right? So on the OTC, very, very common that you have common shares in addition to convertible preferred shares, right? Or preferred shares with special rules or abilities behind them, right? So a lot of times these preferred shares have not hidden, but they have convertible features to them that act almost like there are actual common shares out there that don't trade, right? They're stuck in these preferred shares, but they exist. They're very real and they have a value that a lot of people ignore. So if you go all the way up to the top, a good company that is very good about their preferred share disclosure will go through each of their classes of shares, right? So we can ignore the Series A because no one owns them. The Series B we have to pay attention to. The Series C we have to pay attention to. And the D we can ignore. So B and C are all we need to pay attention to. Oh, sorry, there's more here. E, F, Jesus Christ. We'll not pay attention to these either.
Got a lot of preferred.
Yeah, they got a lot of preferred. It's preferred happy. Luckily, there's not a lot of them.
There's not a lot of issuances I see on G.
Oh, yeah, you're an ILS guy. They're probably one of the biggest preferred share users. They've got like 6 or 7 or 8 classes, so it's tricky, right? So when we think about share classes, right, you have your common and your preferred. Common's what trades on the market. We can buy and sell these ourselves. We cannot buy and sell these, right? In some companies you can, but like a bank or something, or like a REIT, these are openly trading sometimes, but not in this case. So Series B preferred. You can read all this if you want. The most important thing you look for, conversion features. Very, very important. How much common stock does it convert into? In this case, preferred stock at any time shall be regardless of their number. Good to know. Shall be convertible into the number of common shares, which equals 4 times the sum of common shares which are issued and outstanding at the time of conversion, plus the number of total shares that would be issued and outstanding after the Series C people convert. Okay, so we know the Series B and C convert. Red flag, big time. Need to pay attention to this. Well, not a red flag necessarily, but you need to pay attention to it. 4 times the number of common shares. Wow, that is a lot. There's a billion shares, common shares outstanding that you can buy and sell, right? Their preferred stock, preferred B, is equal to 4 times that. So at any time, they own 80% of the company. And the common shares don't exist. But so your common stock, put differently, only is trading into a pool of 20% ownership. Right?
Okay.
We're ignoring the Series C for now, but just these two. So when you see their market cap of 26K or 26 million, multiply that by 5. And that's their real market cap when you take into account what really the company is worth. These 26 million is only based on outstanding shares. Right?
Okay.
So that's very important. I think a lot of people miss that. That's why their market cap seems so low. Why it looks like 26.8 million. And you're like, oh, wow, this company, like a lot of revenue, the operating profits growing a lot. How can it only be worth 26 million? That's why, right? It's really worth more like, 125 million or something like that,
So you're only trading into the fifth of the market cap.
Yeah, fifth of the market.
Actual market cap.
Yes. Yeah. 100. Fifth. Yeah. I got the math right there.
Okay.
Doing math in my head. So we'll look and see who owns these in a second, but you can almost guess they're the founders. Series C, this is a very weird one, but basically what it is I've read this at a time, so I'll skip a lot of this, but each share is convertible into the number of company common stock together equal to 300% of the price paid for Series C preferred stock. So divided then by the current market price. So let's say you paid $1 million for this, multiply that by 300% and then divide by the common share price at the time. That's how many common shares you get.
Okay.
So each person so this is a big red flag for me, just how hard this is to calculate. It's probably not that bad, but if you just look through here, Series C preferred purchased. When they bought here, they gave out 400,000 shares. So you would actually have to go back and do the math at what the common share price was.
And then 1.2 million that turns into.
Yeah.
Essentially.
Yes. So that's sort of the idea, is you would have to go through each and every single one of these and figure out what the value is. And you can see some of them are being canceled. Like this guy's converting his, this is like dilution 101 right here. This guy had Series C preferred. He didn't convert them, he canceled them. Or maybe they're saying he converted, it was canceling, but you can see he clearly got rid of his C and got common shares, right? This is exactly what I'm talking about, of how these shares can just come out of nowhere and T-bone people, right? So if we go down, you want to know who owns these things, right? They have to say, and this is, I'm sorry, Cyberlux people, this is where you'll probably fucking hate me, but they have to say who owns more than 5%. So Brett Rosen says it's 10%. We'll say it's 10% for him, his sake. 10%. So you'll see 3 people with the same last name all own 33% of Series B preferred. So each of these guys owns 1/3 of 80% of the company, right? So basically management owns this company, and they own a little bit of common shares, which I think is really funny that they decided to pay themselves 19 million shares, which is like nothing.
That's funny.
So yeah, this is the idea, right?
Yeah.
This is a management owned company. So we know all the shares, we know what the real common share value is, right? When you do all the conversions, the common share value is more like, let's just call it 5 times, just to make it simple, 5 times 8.6 billion, right? It would go over their authorized share count. Actually, they couldn't actually convert, but they're still worth something if the company gets bought, right? So if people start, sorry, this is a bit of a tangent, but people like to say oh, but they'll never convert, those shares will never trade. Yes, but they still have a value to them, right? So anyone who's valuing the company knows that just because the shares don't exist and they're not tradable doesn't mean that it's not real ownership in the company. So very, very important.
Crazy.
Yes. Yeah. So this is the part that I think gets a little spicy is this is probably a little controversial, I think, that I do this, but honestly, it's my fucking money. And I think that it's important and that you protect your investments, right? I like to do a lot of a deep dive on the people themselves. Um, I'm not like doxing them or anything, but I like to really look up myself personally what sort of public information you can find out about these people, right? And I write about this in that guide you mentioned at the beginning, but looking at like former lawsuits, finding out where they live and seeing like they have to put a residential address. So they live in this city, right? You look up that county and just search the court records, right? There's probably 10,000 Matt Moores in that place, but just see what's there, right? You might see nothing. You probably won't see anything, but you might see like old lawsuits for many things, right? Or unpaid bills or things like that, right? Maybe it
Or
doesn't
maybe you
matter,
found something
maybe it
for
does.
intellectual property for hearing aid development.
Yeah, exactly.
Then oh shit.
Ooh, yeah. Well, it's funny you mentioned that. I'm not sure if you're bringing that up on purpose or not.
No,
But
I'm not.
when you look up this company, if you just look up something like Moore family lawsuit hearing, you're gonna find a lot of info from 2017 that this company, basically the old company, went through. Not this company itself, but the family company before this, which is basically all owned by the same people, had a huge civil lawsuit against them. And they basically had to shut their doors because they were, I'll say, convicted in civil court of basically fraud, defrauding
Oh wow.
people who I won't get into it too much because you can read about it online, and I'm not a lawyer, but um, essentially they're accused or convicted of committing, or actually I think they settled. So maybe I won't say convicted. They settled on a case where they were accused of allegedly, operating without a license, selling. It sounded like they were selling product that didn't work, or selling product to senior citizens who didn't need it or need that exact product. It was a big deal. You should don't use my my explanation for it. Just read it. It's super easy to find on Google, right?
Yeah.
So these are the kinds of things you need to find, right? And you'll find this stuff fairly often, right? So
That's crazy. That's crazy that I brought that up. I was literally only kidding.
I thought you knew ahead of time.
No,
That's why.
100% that was not planned. I did not think that was the thing.
Yeah. So if you look up the other thing I wanted to bring up is if you just go to management, like the actual, their stock page, right? And now I can't find it now that I'm a management team. These are the people, right? So it's clearly just a continuation of the family business that went down before.
Oh, Kim's definitely a criminal. Like, look at her. Like, totally. Yeah.
So the other thing you should be doing is, other than like lawsuits and stuff, just think about what these people qualified. You see a lot of doofuses on the OTC who just bounce around whatever the latest and fad is, right? They were doing a pot stock, and then they were doing e-cigs and vaping, and then they started doing
around
crypto, NFT, whatever. So are these guys qualified? This is what this page is trying to show us that they are. These guys are all been in the hearing industry for a long time. Matt Moore is the son of Mark and Kim. Mark is the chairman of the board. He was also the head of the company that had the big lawsuit. So he's not actually in an operating role, allegedly. He's just the chairman of the board, and he owns a third of the company. Well, not quite a third, but a third of Series B. Kim Moore is a CFO. She has no financial experience, apparently. She was a hearing instrument specialist. Actually, on the OTC, you have to say why you were qualified to prepare the report. So it was actually prepared by her. And it just says she is experienced in the collection of financial information and the preparation of financial statements. So she's not an accountant, not a CPA, but she can prepare these things, right? Take that as you will. Maybe she's good at it. I don't know. This is just going into your Rolodex of things, right? So I would say management and ownership, big red flag for me in this company. Doesn't mean the products aren't going to work. Doesn't mean it's not going to work. It's just a red flag, right? Something that needs to be factored into your risk, right? So that's the idea there. I think so. That's sort of, I think that really rounds out the analysis, right? So
Totally.
you sort of see what the company is, what's their financial performance like, and then who's running the show, right? That's sort of the idea. You'll never get through a whole company without any red flags. If you do, you're doing it wrong. I'm telling you, like there's always going to be something. So would I keep going deeper into this stock? Probably. It's an interesting industry. It's new. I think it's good for the country to have more accessible healthcare and medical equipment, right, over the counter. Am I thrilled about management? No. Do I think there's a lot of red flags financially? Yes. Do I think they're going to need to be raising money in the future? Yes. Oh, and by the way, if you go to subsequent events, they've already actually started raising cash after the year end. So, I mean, you can sort of see where things are going anyways. It's a form.
And that goes back to that whole cash flow statement that you were talking about,
exactly.
to get that more funding. And
yes. Yeah, so they're already doing it. Man. So I mean, the pieces are all falling together here. Doesn't mean this company could be fine, long term. I just have quite a few red flags in general.
Right on.
So that's it. I mean, that's the concept. I think we did this a little under an hour actually by my clock.
Yeah, and you know what? I gotta say, like, this was absolutely, like, this was a meaty breakdown, and you actually, this is a simplification of it. I mean, like, you breezed over a couple things, that.
Yes.
But this is sort of like the nuts and bolts of what to look for, and everyone isn't going to be 27 pages. Some are 55, some are 60, some are every company is different. So I definitely appreciate you like looking through this whole thing. I know that we were trying to think of I'm just trying to get you out of the screen share here.
Oh yeah, here.
I got the what the heck?
There we go.
Oh, there we go. All right, we got it.
Sorry about that.
But no, we were sitting around, we were discussing, like, all right, well, what do we want to break down? And I know I'm glad that we chose this one. We were thinking about doing CYBL, but we didn't want to do that yet.
Oh man, I think the CYBL community would probably kill me if I.
Well, you heard me on my live yesterday, and and some people thought that you were pretty hard on CYBL. I think, you know what, you do bring up certain things. When you look through the whole financials, that's a company that I absolutely love. I'm a big eyeless guy. I like my long holds, my long term plays for 3 to 5 years. But no, I mean, it's nice to look at a perspective of somebody other than like, this is going to be great and it's going to be awesome. Well, let's dive deep into it a little bit more. And me personally, I have my master's in education. So me personally, for my due diligence, I want to learn more about how to read through these 10K reports. And I think anybody that is really concerned about their investment or their money should take the time to learn how to do this. Seriously, it's important due diligence. It really
Absolutely. And I think what I want you guys to get out of this, and this wasn't supposed to be like a bash session of INND, and I think I had some good things to say about them in general, but the whole point of my blog and coming on this show is I'm trying to arm OTC investors to be more informed so that they can demand better things from OTC companies, because a lot of them are fucking garbage. And I think a lot of you guys know that, and they're shady and full of scammers and all of that. And I think the more informed everyone is just about reporting quality and like, does all of this make sense? What they're saying is happening, and just teaching people how to do the exercise like we just did. I think it makes the community a better place for everyone, to be honest. And it cuts out a lot of the crap. Like, people on the OGC don't want garbage on there. Like, maybe some people do, but
shark traders, they don't care about any of this stuff, and they make a lot of money.
Yeah, you don't even open the annual report. You just look at the chart. Yeah.
So, look at the trends. All right, I'm buying here, I'm selling here, and no emotional connection. no, nothing at all. Not marrying any stocks. They trade the chart.
So yeah, I mean, that's sort of the goal here, right? I hopefully this was helpful for you guys, and it just sort of gives you more tools in your arsenal to do DD and raises the expectations for OTC management. So.
Totally. Wow, man, that was super informative. I'm gonna watch it again just so I literally have notes tons of notes that I
Oh,
took
hey.
that I that's why like so if I was looking down, I was actually looking stuff up at like as you were talking. So if I ever look down, it's not that I was falling asleep like a 5-year-old. I was actually doing due diligence while I was doing due diligence, if that makes sense. Sam Aker, dude, absolutely awesome to have you on. Thanks so much for coming on, dude.
Oh, thank you for having me. This has been so much fun. Thank you so much.
And I look forward to having you on a live soon. So I hope you're committed to doing that.
Oh, can't wait. Can't wait.
Awesome. All right, Sam, thank you.
Thank you. Bye.
I hope you guys enjoyed this breakdown. Remember, there's more that binds us than breaks us. You guys have a good night. Peace.